Hello, everyone. Welcome back to our channel and welcome back to the Capital Insights series. This series sits within our Fundamentals to the Noise series. And today, we wanted to talk to you about the rated exit. How Blackstone, Carlyle, and Coller are turning aging buyout fund stakes into bonds for the insurers. Let's start by talking about the instrument out here. What's essentially happening is that Blackstone is marketing more than 2 billion of limited partner stakes in other managers' leveraged buyout funds as collateralized fund obligation, a rated tranched bond sold to the insurers. The headline reads as large deal in the frozen market. The number that matters is buried at the bottom of the page. The equity tranche is taking longer to place, and that's the whole story. So, what exactly is the news if we read it correctly? The vehicle in question sits inside Blackstone's strategic partners, the firm's secondaries arm, which buys LP interests in other sponsors' funds. Rather than sell those stakes outright in a secondary transaction, Blackstone is bundling them into a CFO and slicing the cash flows into rated debt tranches plus a residual equity tranche. At over 2 billion, it would rank amongst the largest such deals on the record, following Carlyle's Alp Invest unit, that is 1.25 billion last year, and Coller Capital's 2.4 billion structured vehicle backed by Barings and Heirs. Now, whether Blackstone ultimately securitizes or reverts to a clean secondary sale is reportedly still open, and that optionality is itself a signal. The senior tranches were never the question out here. Rated AA or A paper backed by diversified pool of fund interest clears readily. Insurers are structurally short of exactly this kind of asset. The live question out here is at the bottom of the capital stack. The first loss equity tranche, where recent deals have taken longer to garner demand and issuers have grown more selective. When the riskiest slice starts to stick, the machine has stopped being a seller's market. So what does the collateralized fund obligation actually do? A CFO, that is collateralized fund obligation, is the private market's cousin of CLO. Aging LP interests, cash flows that arrive at no fixed schedule tied to exits rather than coupons are pooled inside special purpose vehicle. The SPV issues a waterfall of obligations, senior notes with first claims on distributions, mezzanine notes, and an equity tranche that absorbs first losses and keeps the residual upside. A credit rating agency wraps the debt tranches. Carlyle's recent CFO illustrates the geometry. Class A, B, and C notes struck at roughly 50, 65%, and 75% loan to value, with a liquidity facility on top to fund capital calls. Now, the wrapper exists for more than one reason. It changes who is allowed to buy. An insurer cannot easily hold a raw fund interest at scale. It is illiquid, hard to value, and capital punitive. A rated note backed by the same interest is a security with a letter grade, a yield, and a capital charge that a regulator recognizes. The CFO does not change the underlying assets, it changes their legal and regulatory form so that a much larger, cheaper pool of capital can absorb them. And this brings us to the demand side being the thesis. Now, this is the thought line from the base of the stack and the spread beneath the stack. The growth of private capital and reshaping of insurance balance sheets are the same circuit viewed from two ends. Insurers need long-dated, rated, yield-bearing, capital-efficient assets to back their liabilities. The CFO manufactures precisely that out of stakes that would otherwise sit illiquid on secondary's book. Issuance reflects the pull. CFO volume reached a record 25.9 billion in 2025, up from 4.8 billion in 2021, with KBRA rating roughly 37.7 billion across 67 vehicles between 2018 and 2024 and recording no downgrades to 2025. The most revealing development is structural and not numerical. The standard CFO notes mature in 12 to 15 years. The engineering effort of the past year has been to stretch them past 20, padded with zero coupon treasuries and fixed repayment schedules so that they qualify under the matching adjustment regimes that govern the insurer capital. The product is being retooled fit to the buyer's regulatory plumbing rather than seller's exit timetable. When an instrument is designed around the balance sheet that absorbs it, that balance sheet and not the asset is the market. So essentially what we are saying is that when an instrument is engineered to fit the buyer's regulator, the buyer's balance sheet is the market and not the asset. Let's wrap up the video and the topic by reading the gap out here. Now, every CFO sits on top of a gap, the spread between the NAV at which the stake is carried and the price at which it would actually clear. The secondaries market prices the gap openly. Average portfolios changed hands around 90% of the NAV in the first half of 2025, but the average concealed a steep curve by the fund age. The young buyout funds with upside ahead clear in the high 90s, while the tail end vehicles, a decade or more old, the kind that crowd the secondaries book trade at far deeper discounts. The CFO's value to a seller is that it bundles a steeply discounted tail into a pool wherein senior tranches can be rated near par, smoothing the headline discount out of the view. And this is exactly why the equity tranche is the tell. The senior notes price off the rating and diversification. The equity tranche prices off the unvarnished gap. When the first loss demand thins and deals take longer to fill, the marginal buyer repricing the spread between the carried NAV and the realizable value in real time. And this happens through the one part of the structure that rating cannot launder. The 4 million of unsold buyout assets is the supply pressure forcing more of this paper to the market. Equity tranche stickiness is the demand side answering back. Now, that's what we wanted to share with you in this video with respect to the rated exit and how firms like Blackstone are turning aging buyout funds into bonds for the insurers. Hope you've enjoyed this episode. Stay tuned in for our next one.